Hello and welcome to the lecture on access to markets. Today we're going to go through how participants, whether they're retail traders, physical oil traders, or even speculative traders, how they may gain access to the derivative market. So as you can see from this agenda slide, we're going to briefly touch upon retail traders, exchanges, clearing banks and leverage, credit, bilateral agreements, banks, and market makers. So to begin with, we start with exchanges. An exchange allows for more organised trading. So more recently, we've moved to electronic trading, but before this, traders would come together in some physical arrangement, also known as pit trading. So pit trading is where buyers and sellers were able to trade any security, not just oil, through an open outcry system. They still utilised brokers, where the broker would show their affiliation through their jacket colour and their badges to distinguish them from the trader. There were also clerks, which would take the orders by either phone or computer from their client. And then there are people called runners. So these would transmit the orders between the clerks and the brokers who would ultimately execute. Now, as you can imagine, with this physical arrangement, there are a lot of price inefficiencies, such as time delays, etc., using this method. So as we've evolved in the trading world, electronic exchanges have allowed now buyers and sellers to come together quicker and in a more efficient manner, with the main aim to match buyers and sellers together. So the exchanges themselves function in order to allow fair and orderly trading. So as you can see from this slide, I've just listed a few of the exchanges that we deal with in the oil derivative market. So ICE, which is the Intercontinental Exchange, is based in the UK, and a large proportion of oil derivative contracts are traded through this particular exchange, such as a Brent futures contract, which you'll come to know quite well. DME is Dubai Mercantile Exchange, and CME Group is a US-based exchange, which is probably the second most liquid exchange. The CME Group is very important, and as mentioned, the second most developed oil trading platform following ICE. Futures such as RBOB and WTI crude oil futures trade on CME and are settled by that exchange. So now moving on to retail traders. We'll quickly touch upon what exactly retail traders are and how they are important to the market, and then how they access the oil derivative market too. So there are companies such as those listed, for example IG Group, which allow for retail traders to speculate without any physical oil exposure, and thus to trade upon whatever ideas they choose to follow. So these could focus upon macroeconomic ideas or supply and demand models. However, more recently, the retail trend has been towards technical indicators, which allow for them to generate simple trading signals based off historical information. They are able to access the markets, and a large range of these markets, from the comfort of their own home in most cases, at relatively low fees. So generally, retail traders must go through some intermediary, which are known as brokers, where they have to enter into some electronic platform their order, and the broker will execute it on their behalf. They will add to the speculative length in the market, but in terms of actual position sizing, their volumes are quite small, and so they're unlikely to have huge impact into price action. So now moving on to clearing banks and leverage. We'll discuss what a clearing bank is, what margining and leveraging is, and finally what clearing banks' role is in the oil derivative market. So clearing banks act as an intermediary between a trader and the exchange. As you can imagine, for a lot of the physical oil traders, their balance sheets may not be as large as the banks. However, a clearing bank with a large balance sheet is able to face the exchange and take away the credit risk from the trader and onto themselves for a clearing fee. The relationship between a clearing bank and the trader is often what is referred to as margining. So if, as a trader, I want to enter into position, I would have to post some initial margin. This tends to be calculated as a percentage of the notional value of the contract. So I've just put an example on this slide here to give you a quick example of what exactly I would have to post as the initial margin. So if I go into the market and I buy 10,000 barrels of Brent futures contract, and this particular Brent futures contract is currently trading at a $70 per barrel price, I have to take the value of that 1 barrel, multiply it by the number of contracts that I'm purchasing, which in this case is $700,000. My initial margin would be some percentage of this notional value. So in this instance, I've put a 5% initial margin down of $35,000. There are a few other terms it would be helpful to become familiar with, such as maintenance margin. So this is the amount an investor must keep in their margining account when trading to maintain their positions. So if, as a trader, I open 50 different contracts with different notional values, I must ensure that the clearing bank has enough margin to allow for the cumulative exposure of these contracts. The next term is variation margin. Now this is paid daily by the clearing members to the clearing bank to reduce the exposure created by having open contracts. The difference between these is that the maintenance margin is a requirement, whereas the variation margin is actually paid to the clearing bank. So the last term I want to run through is a margin call. This is where a trader is required to deposit more funds into their account because the price is moving adversely to their open positions. All of these terms make up the system of leverage. Leveraging plays a very vital and powerful service in trading, as it allows traders to use the bank's balance sheet to open positions and contracts that they ultimately would not be able to do themselves. So now we move on to credit. Credit gives the trader the ability to access markets and exchange contracts without putting up the entire capital of many open contracts. So it's extremely important to the market because the notional value of, say, a cargo is so large. If, for example, oil is currently trading at $75 and a cargo is 600,000 barrels, we would be looking at a notional value of around $45 million. It's because of this large notional value that it's not realistic for an oil trader to deposit this amount into their accounts to trade the derivatives against them, because they simply do not have access to such large balance sheets. Credit can come in many different forms, but usually it's categorized by whether it's backed by assets or not. So if an oil trader owns an oil field and expects production of, say, 100,000 barrels of oil a month, they will use the derivatives market to lock in the price of that oil in that field. However, in order to finance this derivative trade, the physical oil trader must use either a clearinghouse or a credit line to put up the margin for the trade on his behalf. Because the physical trader has assets with proven cash flows, the bank may use these assets as collateral to back the credit line, and in the case of default, seize the assets that the physical trader owns. So as you can imagine, with asset-backed credit lines, the interest tends to be slightly lower because they are more secured rather than an unsecured credit line where you have no assets backing what the bank is ultimately lending to the oil trader. So now moving on to bilateral agreements. As the name suggests, a bilateral agreement allows for two counterparts to conduct business without adhering to certain regulations or trade barriers that an exchange may have to adhere to. However, the two counterparts put in place some legal agreement, commonly known as an ISDA, in which they both must sign the pre-agreed clauses and technicalities within a trade agreement. So what exactly are the benefits of a bilateral agreement? Although the concept is quite similar, every contract must have a buyer and a seller. Due to the nature of the derivatives market, participants often accumulate large positions before contracts expire. So for example, if you take the Brent futures contracts, you can trade up to 24 months in advance of the contract expiring. So this gives the potential for a trader to accumulate positions in a particular contract for up to 2 years. So if a counterpart changes tact and decides to exit some position, they may look for a similar counterpart that's able to take the desired volume for one price rather than face the market, which may be illiquid and therefore increase the chances of very large slippage. So if we take the WTI Midland contract, for example, it typically isn't very liquid at all, but you do see US oil traders building very large positions in this particular contract. Therefore, if as a trader I had an open position of, say, 1 million barrels long, and I wanted to close this position out, I wouldn't tend to go to the exchange or look for brokers or the screen to match the sellers to my contract. Instead, I may choose to go to a counterpart directly and see if they are able to cross with me at one determined fixed price. You can probably see the immediate benefits for this, but it avoids the issue of liquidity and slippage. These are just some of the market inefficiencies that an individual trader with a large position may avoid. But others include front running, which is the act of a counterpart with the knowledge of your position and trading ahead of you, knowing that your volume is likely to move the market in one particular direction. So, as a trader, I may benefit from these bilateral agreements just because it may ultimately result in a better execution price for me exiting or entering into certain positions. So now I move on to investment banks. We'll touch briefly upon the role of the investment bank and how it's evolved over the last 5 to 10 years. So banks' role has changed dramatically, with their position as liquidity providers significantly diminishing in recent years. However, they're more focusing on their natural advantage of being credit providers. So in some instances, they also provide the service of a clearinghouse where, as mentioned before, they face the exchange and alleviate the credit risk that a trader would face. Now again, this is due to the nature of the bank's balance sheets. They are very well positioned to offer favourable terms and conditions to all traders for financing because they have the assets and these large balance sheets behind them. However, not very long ago, banks were major participants in the oil industry and held contracts with physical oil companies and were in turn offering credit to facilitate trading derivatives. In turn, the oil company would then execute through the bank as well, leading the banks to become full service providers. However, as mentioned, the involvement has come about due to this restriction, so the physical oil traders often did not get the best execution service, which thus left room for trading houses in the form of market makers. So the inefficiency within the OTC derivative market was readily apparent, with the banks able to charge very large bid-offer spreads on relatively low-risk deals. As the trading houses, such as Onyx Commodities, entered into the commodity derivative markets, they were able to provide a better counterpart service by offering more competitive pricing than banks. As the margin on liquid trades started to narrow, many of the banks were then forced to exit their role in trading and execution, and instead focused on areas where they had a better competitive advantage, such as credit lending. Very typically, a market maker's balance sheet is not so heavily asset weighted. However, their role in the market is to show counter prices to market takers, and therefore their balance sheet is really of no importance. More often than not, when they enter into certain positions with the market makers will close the position out for some small margin and choose not to hold large positions for a sustained period of time. We thus call this having risk-neutral positions. Due to this, they will tend to have favourable conditions from a clearinghouse, which faces the exchange, in terms of their leveraging, etc., because they're deemed as low risk. So this moves on quite nicely to brokers and screen trading. As mentioned before, because market makers tend to use clearinghouses for them to gain access to the exchange, there are two ways in which they're able to do so. The market is accessible via brokers or through exchange-based screens where you're able to access the exchange directly through your clearer. Brokers charge a servicing fee called a brokerage rate, which is charged by volume to each counterpart on both sides of the trade. Now this is known as a servicing fee for matching the buyer and the seller together. So more recently, the OTC market has moved away from using brokers for every single trade and has instead moved to screen-based trading, as it allows counterparts to access the market at fees which are much lower than trading through brokers. Often, if a broker matches counterparts together for a very large volume that's being posted to the exchange, the names of each counterpart can tend to get leaked into the market as well. And so this can allow for the entire market to know which positions certain counterparts are holding. Now, as you can imagine, screen trading allows for the discretion in this, in that nobody knows who's on either side of the trade, because there's no individual conducting the arrangement between both the buyer and the seller. Therefore, privacy and discretion are two major advantages to moving away from OTC trading and towards screen-based trading. So that concludes the Access to Markets lecture. We've explored a few ways that traders are able to access the market, depending on their credit restrictions, what exactly they're executing, whether they're trading more niche contracts or they need access to more exotic derivatives. So for example, if I was a US trader with a Midlands physical oil field, then I'd probably need to go to a broker to access someone who's able to offer me the correct terms of contract, rather than go directly to the exchange. So, as mentioned here, the credit restrictions, the particular contracts and the niche requirements will all determine exactly how the oil trader will access the derivatives market. Thank you for listening.